Hi everyone, I hope you are staying well. My name is Mardy Chiah and I'm a lecturer in finance at Swinburne. Let's talk about share market, particularly what happens to the share market during the COVID-19 pandemic. In addition to working from home, people around the world are found to be trading from home. Trading volumes peaked at one of the highest levels yet, both internationally and in Australia, during lockdowns imposed in response to COVID-19. Data shows there was a 50% spike in trading volumes globally and a 66% jump in Australia out of 37 developing and developed countries during the first COVID wave for the period 23rd of January to 15th of May 2020. In Australia, prior to COVID-19, the average daily turnover was 0.27%. In stark comparison with the daily turnover of 0.44% during COVID-19. The surge in trading volume was highest in countries with a greater level of trust in the society, lower avoidance of uncertainty, and in countries with a higher degree of individualism or overconfidence. This is found to be driven by retail investors to a large extent. During the lockdown imposed by many countries, people working from home, and particularly those in the younger age group with some savings, had ample time to participate in the stock market. It is likely that investors resorted to the share market for a range of reasons, including to secure a bargain, from a fear of missing out, and to participate in get-rich-quick schemes. We saw this occurrence with the emerging Robinhood traders phenomena in the US, with young, inexperienced retail investors entering the share market for the first time during the pandemic. The closure of casinos and other gambling venues due to the pandemic is another factor associated with the increase in trading volume in stocks, as people trading from home sought a substitute for gambling. Past research shows that retail investors are more likely to trade in stocks with lottery-like features and regard the stock market as a substitute for gambling. Overall, investors in countries with stronger economic development traded more, implying that wealthier nations are diverting their savings to the share market during the outbreak. Countries that distributed stimulus payments are also associated with larger increase in trading volume, raising a concern of the use of stimulus payments. For instance, it is likely that some investors spend their job seeker payments in the share market in Australia to engage in risky short-term trading. This brings significant public policy implications as traditional gambling is regulated and taxed as a social wrong, whereas financial markets are not. Retail investors chasing quick profits by playing the market over the short term have traditionally performed poorly in good times and bad times, and even in relatively stable, less volatile market conditions. Our research is in line with the report by the Australian Securities and Investment Commission, ASIC, which warns retail investors in May about the trading frenzy during the pandemic. ASIC warns that short-term trading and poor market timing by retail investors is highly risky. Therefore, retail investors should be wary of trying to play the market for short-term price movements by day trading. The other potential concern for Australian investors is related to the early access of superannuation fund during COVID-19. If the early withdrawal of superannuation is spent on the volatile market, some investors may lose their retirement savings. Thanks for watching the video and stay safe.